Did you know you're actually a third of the way to becoming a millionaire once you have $100,000? No, my calculations are not wildly off. It's true. 100K is an incredible tipping point where your money really starts to work hard for you. And if you don't believe me, stay tuned. We're about to show you the magical math that makes it possible and what you can do to reach this life-changing milestone a little quicker. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, your guide to leveling up your investing skills with perspective from savvy DIY investors and financial pros. Brought to you by TD Direct Investing. I'm your host, Rob Moise. And I'm excited about today's show because we're going to have fun with the numbers, and I love doing that. Our special guest will explain why 100K is such a powerful figure for investors to reach, and he'll also share 3 simple saving and investing habits that can get you closer to it. Joining us is Nelson Soh. He's a TEDx speaker, best-selling author, and financial literacy advocate. Nelson, it's great to have you back on the show with us. It's been a while. Thanks for taking the time.
Thanks, Rob. This is great. I'm super excited to be here today.
Yeah, you've got great stuff on your socials that help people understand, the basics of financial literacy and things like getting to 100K. So you're the man for the job here. But tell us, why is 100K such a big deal for investors? 100K,
it's such an important milestone because when compound interest starts to add meaningful amounts to your money is when you hit the 100K mark. So compound interest, for those who don't know, is interest your money earns on the interest you've already earned. So for example, in year one, let's say you invested $1,000 and it earns 10%. That investment would earn $100 of interest gains, which would be $1,100 in total. Now in year two, that $1,100, assuming that you don't take any of it out, earns an additional 10%. So now your $100 gain is now $110. And this is where and how the compounding works. So in year three, your balance is now $1,210, and that also earns 10%. So now your gains are $121. So as you can see, the gains grow every year. The amount of money earned is small at first, but it grows exponentially over the long term. It gets really exciting to see compound interest at work after you've hit that 100K mark, because you could earn thousands of dollars every year.
Yeah, at first it seems like, chump change and what's the big deal, but as you let it run longer and longer, it really starts to take on a life of its own. And we teased that in the intro, saying 100K is a third of the way to $1 million. No, folks, that is not fuzzy math. It's actually true. Let's not leave them in suspense any longer here, Nelson. Talk us through how the heck that's possible.
Of course, Rob, let's make that math, right? So let's say you invest $100 a week. And for many people, that's quite doable, $400 a month. And let's say that it earns an average of 9% annually. Roughly, the S&P 500 returns about 9% annual. So if you take 12 years, you'll get to that $100,000 mark. And now the cool part is 12 years later, if you continue on that same path, you reinvest your dividends, you hold your investments, and you keep contributing consistently, now your money is actually $400,000. So as you can see, that 12-year increment has actually quadrupled your money. And here's where the math and the magic happens. Add another 12 years, and now your balance is over $1 million. And the cool part, Rob, is that you've actually earned about $90,000 of interest in that last year. So in other words, your portfolio's interest might be earning more money than at your job. And if you can keep investing that $100 a week consistently and reinvest the returns like we just talked about, you can be on that millionaire track in about 36 years. And the nice thing about this, when you look at the numbers, is you've only really contributed about $168,000 to earn that $1 million. So the more that you can contribute and the more regularly you contribute, the faster you will benefit from compound interest.
Yeah, that's the part that really blows my mind, that you only contributed about 168K or so, and you got $1 million. Yeah, sure, it took some time, but I think that's a trade that a lot of people would make. And the other thing too is, if you increase the amount of money that you're contributing, you're gonna get there even faster, right? So it's really incredible stuff. That said, if you're starting from zero, 100K can still feel pretty daunting. Like, what can somebody do, I guess, from a psychological perspective to kind of get over the hump and make it feel not so difficult to reach?
Yeah, think of it like climbing a mountain, right? Like nobody climbs a mountain in a single bound, like in one step. Just break it down into smaller steps instead. So when you take that 100K, break it down into years and then months and then weeks, and then see how much you need to contribute to get there. You can use a tool like an investment calculator, because I know when I was at that point, I started at zero. 100K sounds like a lot, but when you really step back and cut it down into smaller chunks, $100 per week is quite manageable. Maybe it's a couple meals out that you sacrifice and you cook at home, but that contributes to your future.
Okay, we're going to get into some of those habits that you feel can help young Canadians get to 100K a little bit faster. If you're in the audience and you want to know how to get there faster, you've got a question for Nelson, make sure you submit them to us. We'll get to as many as we can later on in the show. If you're watching on Webworker, it's the chat box you want to use to send your questions to us. If you're watching on our broadcast platform, it's the questions and comments box. And if you're watching on our YouTube live stream, there's a link in the description you can click to join the broadcast platform, and that's where you can ask your questions. All right, Nelson, let's get into your first habit. This is a great one. It's pay yourself first. For those who aren't familiar, just help us understand what is pay yourself first and why is it so important to reaching your first 100K?
This might be my favorite one, Rob. Pay yourself first means automatically setting aside a portion of your earnings every month for savings and investing. So like you earn a paycheck, a portion of it goes away. This helps you avoid spending all of your money before you invest or forgetting to invest at the end of the month. So what you can do, like a helpful tip, is to treat this like a fixed expense, similar to your rent or utilities, and learn to live off the remaining money that you have left. Having the money available and readily set aside makes it easy for you to stay consistent and lets compound interest work for you as soon as possible. It's also a good idea to automate your contributions into your investment accounts. This makes it easier to invest and helps ensure that you don't forget to invest that money over time. You can also set up automatic transfers into your brokerage accounts and then invest from there. It's kind of like a set it and forget it type of strategy.
Yeah, I mean, anything that takes some of like the thinking out of the process is always welcome for sure. That said, I mean, what's a reasonable percentage in your mind for somebody to be setting aside each month, particularly if it's like a young Canadian, they might not be making a ton of money. What's that percentage that you think could work for them?
My general rule of thumb is to set aside a minimum of 10% of your after-tax earnings each month to save and invest. So after-tax means, after all your payroll deductions, tax withholdings, etc. A lot of people will think, well, my employment contract says I make $50,000, $60,000 a year. I'm going to put away 10% of that. I really want you to consider after-tax earnings, because there's some other stuff that you'll need to account for as well, like the payroll contributions, etc. But it's important to build the habit with whatever amount you can to set aside to start.
Mm-hmm. Yeah, and that's a really good point. I think a lot of people might struggle at the start thinking, I can't possibly set this money aside. I won't have enough left over. But it's actually a lot easier for a lot of people than you might think. We always have the temptation to find ways to spend money that are in front of us. But if we just don't put that money in front of us and we already set it aside, we don't have that problem. And we kind of learn to live off the rest. We're very adaptable creatures, right, us humans. But that said, let's say somebody doesn't have much money per month to set aside. Even, they crunch the numbers and they realize I only got like 25 or 50 bucks a week or something like that. Is there anything they can do to kind of stretch the value of that dollar and help them get towards that 100K a little bit faster?
That's an awesome question, and I'm so glad you asked, because over the last 5 to 10 years, we've been able to invest in partial shares through our brokerage account. So way back when, you had to buy whole shares, so you had to have the full amount to buy one unit. But now you can actually buy a partial share. A partial share is a fraction of one share of a company's stock or a fraction of a unit of an exchange-traded fund or ETF. So for example, say the stock you want to buy is currently market priced at $100, but you only have the 10, 25, 50 bucks left to invest. You can place an order for that $10, which means that you would own, 1/10 or one fraction of that stock. So even small amounts can compound into a lot over the long term. So don't overlook it and don't wait to invest when you have that money. Invest it as soon as possible. So going back to that example, if you can only invest $25 a week, let's say that's $100 a month, you could still end up being a millionaire in 46 years if you consistently invested and you earn that 9 to 10 average annual return. Now, along similar lines, consider turning on dividend reinvestments. We like to call them DRIP programs. It's like dividend reinvestment programs for any dividend stocks or any ETFs that you hold. And the beauty of this is it automatically reinvests the dividends for you. So whenever you get paid, it goes back in and you don't have to think about it. You don't have to set time aside. It just does it for you.
Yeah, it's a really powerful feature. I remember I came across a study one time that said, what are some of the best performing accounts, brokerage accounts out there? And one of the best performing accounts that was out there, if not the best, was dead people. because they couldn't get in there and like fiddle with their money, and not everything was just happening on autopilot, and their money kept raising higher and higher over time, right? So same kind of idea for us living people. That said, let's get to your second habit, because this is about having more cash to invest, and that's to keep your expenses and your spending as low as possible. This involves a degree of budgeting, and I can hear the groans in the crowd already. I know that it's not something that I look forward to when I have to think about it. Do you have an approach, Nelson, that can make budgeting a little bit less uncomfortable, a little bit more approachable for people?
Oh man, Rob, you brought up the notorious B word. But to be honest with you, I actually like budgeting. And for me, I like to keep it simple. So I like to use the 50-30-20 budget as a framework to build the habit around thoughtful spending. So how this budget works is you take 100% of your income and you split it into 3 categories. The first one will be 50%, and it represents your needs. So things like rent, groceries, utility, transportation, things that you need to get your life going, essentials. 30% goes into wants, like dining out, entertainment, hobbies, vacations. And then that last 20% goes into future like things like saving, investing, emergency funds, and maybe even repaying some debts. Now, I like this framework because it leaves enough room for most people to live comfortably while still working towards that first 100K. Now, the important thing is to be thoughtful and disciplined about your spending. So pick 2 or 3 things that really matter a lot to you and spend on them without any guilt. I mean, obviously be reasonable about it, but try to trim your costs on everything else while you can. You may find that there's a lot more room to save when you only spend on things that you truly want, that improve the quality of your life and really bring you joy and happiness.
Yeah, I think 50-30-20 is a great jumping off point. And I'm curious, like for you, Nelson, when you're going through that exercise and you're finding those things that really matter to you, like what are you spending most of your money on and kind of focusing on cutting out the rest?
Yeah, so for me, like I know my financial cycle quite well, so I keep it simple and I track the 3 of my biggest discretionary expenses. Those would be things like eating out, groceries, and shopping. So I try to manage those and keep them within reason every month, so then I know that the rest of my budget's going to be on check as well.
Mm-hmm. Yeah, like those. We sometimes hear like, oh, if you cut out the $5 Starbucks, that'll help you get closer. And to some extent that's true. But at the same time, like maybe you like having your Starbucks coffee every morning. Like you want it to be sustainable ultimately, right? I mean, like that's the key. I know anytime I've tried to diet in the past, I starve myself for 2 weeks and then I demolish a bag of chips like the next day, right? So it's all about sustainability. And I think the 20-30 or 50-30-20 is a really good jumping off point for that. Is it something that you've stuck with your whole time, or have you sort of tweaked 50-30-20 as you've sort of gotten more control over your finances?
Yeah, 50-20-30 is just a starting template. Whatever your personal financial situation or life circumstances might be, I highly encourage you to try different ratios that might work. So you might find like a 60-20-20 makes more sense. Like if you live in a city like Toronto or Vancouver where maybe housing costs are a little bit more, that 50% might not be sufficient to cover your utilities, rent, or housing costs, right? So you might need to change that ratio as you go, but definitely play around with it and try to have those 3 buckets, because having those 3 fundamental buckets keeps it pretty structured.
Yeah, I think another thing too for people to keep in mind is like, let's say you have a month where you are able to do, the 20 of saving and investing, you're actually able to squeeze out like 25. Well, don't sit on your laurels here, get that money working for you too, right? Use the getting ahead a little bit as faster as much as you can. Those little bits like really make a difference. Speaking of doing things that can squeeze out a little bit more savings and do a difference, I want to play a clip for you. We recently spoke to DIY investor Joy Yang, and she had a very unconventional, albeit effective in her case, approach to maximizing her savings.
And I also ate the same meal every day for forever, for as long as I can remember. $7.99 Costco chicken, and then a cup of macaroni, and that was it. Sometimes I would add hot sauce and soy sauce in it though. So yeah, it was tasty enough for me where I could do it consistently. Like I wasn't wanting to throw up every time I ate it, which is a bonus.
Nelson, I'm curious, do you think this level of extreme frugality that Joy is doing is this generally speaking a smart move, or is this kind of like a little bit excessive, a little bit silly if you're somebody who wants to reach 100K ASAP?
Oh man, I love Joy's content. It's awesome. For this one, I'd say, create that budget and spend within your means. Like if you like your $8 lattes, but you want to cut back in other areas to be able to afford things that you enjoy, you can still do that while hitting your 100K goal. But hey, you know what? If Costco chicken and macaroni is your thing with a little bit of soy sauce and hot sauce, go for it.
I gotta say, like, I tried to do the meal prep thing years ago where you like cook for the whole week on Sunday, and by Wednesday, like, I just wanted to end things. Like it's not something that I could do, but like kudos to Joy for sticking for it so long. She was actually able to buy her first home in her early 20s in part because she was saving and investing so aggressively, and I guess using those extra little bits of savings from the Costco chicken routine to get her a little bit closer to the goal. So, I mean, it's fantastic stuff. In any case, one of the things that I think a lot of people, particularly young Canadians, can get in trouble with is debt, right? There's often some form of debt that we have. It could be student loans, could be car payments, credit cards. Do you have any tips for young Canadians who, they're trying to make ends meet, they're trying to, enjoy their life, obviously, but they obviously want to save for the future too. Any tips for them to help, avoid getting in trouble with debt and staying ahead of that?
Yeah, for sure. Debt is a huge topic. There's, all debt is not measured the same. There's good debt, there's bad debt. But what I'll say to anybody trying to get their finances in check is that you need to avoid carrying high interest debt like it's the plague. I'm going to say that again. Avoid carrying high interest debt like it's the plague. So most commonly, you'll find this in credit cards for high interest debt. And it's also important to remember that just because you have access to credit, it doesn't mean that it's, I'm going to use air quotes here, free money. It's just a financial tool that you can use in place of money you don't have on hand at the moment. So always remember, especially with credit cards, I'm going to keep hammering this home, pay your statement balances in full and on time with no exceptions if you can. I understand that some people have different financial and life circumstances. You may need to carry that balance for a couple months, but do whatever you can to get that balance down to zero as soon as you can.
You have a really fun rule that you were telling me off camera that if you can't afford something twice over, you can't afford it. Can you just unpack that thought for us a little bit?
Yeah, if you can't afford it in cash twice, then you can't afford it. So a lot of people are, they get a pay raise and they're like, great, Rob, I'm going to go to the dealership and I'm going to upgrade my car just because I'm making extra $10,000 a month. But can you really afford that? And I think people really need to think about that. So my rule is if you can't afford it in cash twice, then you can't afford it.
That's a good rule of thumb. Because lifestyle creep is real, and it comes unexpectedly for sure. Speaking of unexpected, one of the ways that Canadians often get into trouble is, as we were talking about with credit card debt. I think a lot of people at first blush would be like, yeah, that's obvious. Like, obviously, I wouldn't get into a situation where I'm racking up credit card debt. And yet it happens to more people than you might think. Like, can you give us an example or two of ways that can happen that can really catch people off guard?
Yeah. Credit card debt looks like it's really innocent and you're just using it and you'll pay it off eventually. But one area that people often fall pitfall to is paying for vacations on a credit card because it often leads to ballooning interest costs. So if you don't pay off an expensive vacation in full by your next statement due date, you could start racking up a lot of interest and it's hard to get ahead of it. So for example, let's say you pay for a $5,000 all-inclusive vacation package on a credit card with a 20% annual interest rate. It'll take you, let's say, 2 years to pay that off in full if you contribute $250 per month towards paying it down. Now, in total, you'll be spending $1,100 on interest. So this $5,000 vacation that you thought was $5,000 is now over $6,000. And this is where the interest cost can balloon up over time when you don't pay your balances in full.
Yeah, it's a really illustrative example for sure. It hits home for me because I actually just last night booked a vacation on my credit card. But Nelson, you'd be proud because I always pay off my credit cards in full every single time. So I'm not going to get into trouble with
Proud
this
of you,
one, okay?
Rob.
Yeah, there you go. Thank you. I'm going to pat myself on the back. Let's get to your third habit though, and this is to invest within your means. Just tell us exactly what do you mean by that? How does that help get us closer to our first 100K?
Yeah, I think the important part is within your means. Invest in a way that fits within your lifestyle and your personality. This is crucial to staying consistent with your investing and putting as much money to work in your investments as soon as possible. Because remember, we're all emotional creatures. What works best on paper and works best for me might not be what works best for you based on your temperament, your circumstances, and your choices. For example, history suggests that investing in a 100% stock portfolio would likely yield higher returns over a 60-40 stock to fixed income portfolio. However, If you panic sell during a market downturn because you can't emotionally handle the price volatility and the market volatility, you aren't going to realize those theoretical higher returns. In fact, you might actually be worse off than if you had just put your money into a 60-40 split portfolio and just rode through the volatility.
Yeah, it's a really good point. Like, we are emotional creatures. It does take some time, I think, to appreciate what your actual risk tolerance is. And I'm curious, because it's such like a difficult thing to get a handle on. What do you think, somebody could do to get a good sense of what their, like, quote unquote true risk tolerance is, before they have to learn it the hard way by, investing in a 100% stock portfolio, the market, dips and slaps them in the face and then they panic sell, right? Like, we don't want that. So what could somebody do?
Yeah, my rule of thumb around risk tolerance is that if you feel like you would feel like awful or stressed if your portfolio dropped a certain percentage or a dollar amount, then your risk tolerance is probably lower than you might have thought. So play around with an asset allocation calculator and lower your exposure to riskier investments like stocks, like individual stocks, until the expected volatility feels like something that you can handle. It's important to reassess your risk tolerance periodically, because as a newer investor, you might feel like you have a lower risk tolerance at first, but then realize maybe that you can stomach a little bit more volatility once you get a little bit more comfortable with financial markets. Something I want to point out as well to consider is that there's actually risk in not taking enough risk. And I know that sounds kind of weird, but ask yourself if you're comfortable with losing 2 to 3% of your savings value each month or each year, due to inflation. If you're not comfortable with that, then you probably need to take on a little bit more investment risk to offset the inflation.
That's a really good point. I think a lot of people don't think of, but inflation is a very insidious creature that kind of slowly eats away at your money. So there is probably a happy balance that most people can find between risk and reward that can help move their money in the right direction over time. But in any case, I'm speaking of investing, I'm curious if you think there's a strategy that your everyday investor who probably isn't like super dialed into analyzing financial statements and stuff like that, they want to live their life but they want to invest for the future. Is there an investing strategy that you think could help them reach their first 100K a little quicker?
Yeah, contrary to what you might see on social media, I'm actually a big believer in dollar cost averaging into index ETFs for everyday investors. So an index ETF tracks a specific market benchmark by holding a collection of investments that mirror its composition. So for example, the S&P 500 index represents the 500 largest publicly traded US companies. So an S&P 500 index ETF would hold those same 500 stocks. Dollar cost averaging is consistently investing the same amount of money every single month, no matter what that ETF's price is doing. So this removes the thinking and the emotion from my investing, which makes it easier for me to stay consistent. To be honest, I like index ETFs for a few reasons. It's a simple strategy to follow. It requires less research because you're so diversified. Like if you buy an S&P 500 index ETF, you're buying the whole S&P 500. So you're spreading the investment risk across many investments, which tend to average out their performance. And with ETFs, there's such strong historical performance. For me, it's a no-brainer.
Yeah, I mean, certainly we don't know what's going to happen in the future, but there's a 100+ year history that would suggest that, these diversified indexes have done very well. And, maybe reasonably somebody could think that you might get something in that ballpark at least. At least it's a nice way to, I guess, build a little bit of comfort, confidence in what you're doing. That said, diversification is a big part of this, as you mentioned. And I'm curious to get your take on a popular investing strategy, kind of dubbed S&P 500 and chill. You brought up the S&P 500 index as an example. And really, the idea behind this strategy is your entire portfolio is just one S&P 500 index ETF, and you're just regularly contributing to it. Back in January, we heard from a 22-year-old DIY investor, JC Sage. She was telling us she thinks this is a good strategy.
It's a classic low-risk choice. The S&P 500 generally reflects the entire stock market. So if the stock market does have a downturn, we as Gen Zers have time to wait for it to recover because we're not selling our investments anytime soon. And of course, there's definitely a small chance that the market is super bad for a very long period of time, but that would be very unusual. And then at that point, I tell myself that everyone's in the same position as me. That said, it's definitely a good idea to diversify more later in life as your focus shifts from building your investments to preserving your portfolio.
Okay, so Nelson, we heard JC, make her case there. I'm curious, are you yay or nay on S&P 500 and chill strategy? For young investors specifically who are looking to get their first 100K, do they need more diversification than that, or is that sufficient in your mind, generally speaking?
For a young investor, somebody who's just starting, I think it's great. It's simple, it's easy. You set it and forget it. But I do want to point out that investing only in the S&P 500 exposes you only to one market, like the US market. And you want to think about, do I want to also invest in the Canadian market, in the global market, or emerging markets? And that's a different type of diversification. But S&P 500 and chill, I'm for it because it's, a great way.
Yeah,
it's simple, easy, set and forget.
I think, the set it and forget it kind of aspect of things is really powerful. There are other, obviously, index funds out there that do cover the whole global stock market or something akin to that if that's the way that you want to go. But interested to get your take there. We also heard the other side of the coin, though, recently. DIY investor Robin Speziali was telling us that you basically just can't get rich off of index funds.
Yeah, so if you were to ask any of the Forbes 500, let's say billionaires, multimillionaires, no one would ever tell you from the Forbes list that I got rich investing in an index, investing in an ETF. It's really a big concentrated bets in a small number of companies.
So Nelson, I'm curious to get your take on this. What would you say to a skeptic like Robin, who's arguing that you're better off trying to invest in the next big thing, the next Amazon, Nvidia, Tesla, whatever you want to call it, if you want to get to 100K faster and you ultimately want to live that yacht lifestyle or whatever rich is to you?
You know what, Rob? It's exceptionally difficult to predict which stocks will become the next big thing. You're much more likely to invest in one that doesn't, and you'll get worse returns as a result, and it'll set you back and it'll take you longer to get to that next 100K. So considering that less than 15% of the companies in the S&P 500 index have been responsible for the majority of its returns over the last 50 years, I think it's a pretty safe bet to bet on the S&P 500 or any sort of index ETF. And based on my experience, even financial professionals can't beat the index, or they have a very hard time in beating the index most of the time. So the index ETFs beat nearly 99% of actively managed Canadian equity funds over the last 10 years. Those are some pretty good stats if you ask me.
Yeah, it was wild, looking up these stats. A company, S&P Global, does this, and they track, by country, how do active managers, basically people trying to beat the market, how do they perform against the market? And certainly over a 10-year period, the results are not in their favor, certainly. It's quite stark in Canada. So I guess that's, a way for, a young investor who's just getting into this and they're new to investing. You don't have to be a stock bro, genius or something like that to build wealth and get to that 100K, right? You can take a sort of more steady Eddie approach if history is any guide. I do want to bring up another point, though, that a lot of people will bring up. They'll say, look, I think that the stock market is overvalued right now. I think we're about to have a recession or something like that. Shouldn't I just hold off investing until things kind of settle down a little bit? What would you say to that?
I think it's impossible to time the market. I mean, everybody, when they buy low and sell high, all of a sudden they're this genius about the market, but it's impossible to predict. How will you know when the right time to buy back into the market will be? You risk missing out on great returns trying to find the bottom of the market. And then again, it might take you longer to get to that 100K. I think there's some great research around dollar cost averaging, and it says that it beats the dip in most cases over the last 100 years. Missing the absolute bottom by just 2 months lowers the chance of buying the dip outperforming DCA to just 3%. So for me, DCA is a great strategy because you ride those ups and downs, and over time you kind of have that average cost as opposed to trying to time it because you'll never know when.
Yeah, you'll be buying at the highs, you'll be buying at the lows, and it all kind of averages out, evens out at the end. So anyway, great to get your take on that. One last one for you. TFSA, RSP, these tax sheltered accounts are obviously one way to help grow your money faster. You don't have to pay the tax, or you pay it later down the line. Is there an order that you think is generally best to contribute to these accounts?
Yeah, generally I would prioritize maxing out the TFSA first. It probably isn't worthwhile to use up RSP contribution room if you're early in your career or if you're in a relatively lower tax bracket with the potential to be in a higher tax bracket in the future. You could also open a first home savings account, or FHSA, and contribute to it after you max out your TFSA. And then you could use that money to buy a home or roll it over into an RSP in the future, because this doesn't affect your RSP contribution room. So it's kind of like extra room. I would also prioritize RSPs if you're a higher income earner and you're paying more income tax, because the RSP takes down your marginal tax rate. And always, make a note to reinvest your tax refunds, because this will accelerate the compound interest in your portfolio. But if you're saving for a home specifically, I would definitely prioritize something like an FHSA.
Okay, so yeah, I mean, certainly that does depend on your goal specifically. FHSA is tailor-made for saving for a home, obviously.
Yes.
Is there like a line in the sand, though, when it comes to income where you think RSP starts to make more sense over TFSA?
For me, I would say around like 70 to 80,000. Like once you start hitting that, you can start seeing some worthwhile returns from investing in your RSP. And remember that you don't have to do it all at once. Like you don't have to contribute 20, 30,000 right away into your RSP. Like you can slowly bring it up. So as you start to hit $70,000, $80,000 in your income, you can put in 5,000, 10,000. And as your income starts to increase, then you can also increase those amounts to really draw down that marginal tax rate.
All right, some fantastic rules of thumb, and thank you so much, Nelson, for sharing those saving and investing habits with us. These are real needle movers, so it's great to hear them. We had a lot more to get to, including our live Q&A, but before we continue, just a quick note to our viewers that if you're finding this interesting, educational, you want more of it, we got more of it. Check out TD Direct Investing on social media. We're on YouTube, we're on Facebook, we're on Instagram as well. There's QR codes on screen you can scan to check out all the educational content that we have designed to help you build your investing knowledge. So don't miss out. Like I said, live viewer Q&A coming up in just a few minutes. So if you don't have your questions in yet, make sure you get them in for Nelson. But first, though, I want to bring in my colleague, Caitlin Cormier, because she's going to show us how to start investing towards your first 100K in TD Easy Trade. Caitlin, welcome back to the program. Great to see you as always.
Absolutely. Nice to be here, Rob.
It's actually a great time to get started on TD Easy Trade because we've got a great promotional offer going on right now. Tell us about it.
Yeah, absolutely. So we've launched this new look for TD Easy Trade, the app, and we have an offer right now for $100 of partial shares for free. So both new clients to TD Easy Trade and existing clients can participate in this offer. So what you need to do is make sure that your app is up to date. It's the most up-to-date app currently. You have at least one new account between March 31st and June 30th that you open. So if you have like a TFSA, you can open an FHSA or an RSP. The offer will show up, and I'll show you that in just a moment, in the offers section of your app. Once you have the account open, that's where you're going to select 3 different shares that you'd like partial shares of, and you need to do that before July 31st. You have to put at least $2,500 into the new accounts, so between the different accounts, but up at least $2,500 into those accounts before July 31st, and keep it there. And then also you do need to have a cash account. So if you don't have a cash account, you need to make sure you have one of those open, because that's where the shares are deposited into once you get the partial shares. So let's hop into the platform and see where we're going to get this information. This little present on the top right-hand side of the screen is where you're going to see those rewards and offers. This lovely little sushi picture here is giving you some of those Coles notes of the things I just told you about this particular offer. If we just go back, there is actually down here under the Learn section, along with a bunch of other great content right here. There's even information specifically on the partial shares offer. There's actually 3 videos you can watch. One of them features you and I, Rob, from a couple weeks ago, which is just going through the same sort of stuff, as well as some other information about the offer. And then finally, the last thing I want to show you is under the account section, where you'll be able to see those shares once they're deposited. So under Home, you're going to be able to click right on your account, of course, your cash account, and then Activity is going to be where those shares will show up.
All right, I mean, like $100 in partial shares, who would say no to that? And plus, who would say no to seeing more of Caitlin and Rob on the platform as well? There you go.
Dynamic duo.
I want to ask you something, because Nelson was bringing up this idea of pay yourself first as like a really powerful habit, and setting up automatic transfers into your account. How do you go about doing that?
Yeah, so right within, again, we can hop right back into the app here. At the bottom, there's a little button that says Move Money. This is where you can come to set up those transfers. So just on the bottom here, Move Money. You can make transfers either between accounts outside of TD or within TD accounts. Let's just say that you have an account with TD. You can go ahead and choose that account that you want to transfer into. In this case, this particular account is a demo account, so it's not going to let me. So let's choose outside of TD. And you'll notice here that I have the option to choose recurring. So that's what I'm going to do. I'm going to say I want to put money in on a regular basis into that account. And it's going to basically go through that open banking process, I believe, and kind of get my information to confirm that I want to move forward with that regular contribution. So really, really important and very easy to do on the app.
Yeah, it's awesome that it's just a few taps away to set something like that up. One other thing that Nelson mentioned, obviously we were talking about, and it's featured in this offer too, partial shares. Where do I go to get partial shares? Like if I want to buy something, how do I get them?
Absolutely. So it's just a part of the trading process. So partial shares, we also call it dollar-based investing. So you want to invest $1,000, you invest the whole thing as opposed to only a certain number of shares. If we go into the platform and we click on this trade button, this is where you can go to either buy ETFs or stocks, whichever you're looking for. So you can see, for example, I know we talked about VFV, so I'll just type that in. You'll see that that is an option here. And then once it pops up, when you click buy, it will show you that you can actually put a dollar amount in. It's partial shares eligible. So instead of having to put like I want to buy 10 shares, I can literally just put a dollar amount in and it will let me know how many shares I can buy. You can switch back and forth between number of shares or dollar amount. But again, if we're just looking to do dollar amount, then it will actually do that math for us.
I love that. Anything that does math for me, I'm all about it. That's fantastic stuff. Appreciate you showing us the ropes as always, Caitlin. That was TD Direct Investing's Senior Client Education Instructor, Caitlin Cormier. All right, Nelson, the time is upon us. Let's open the floor. Let's take some questions from our viewers. Are you ready to rock?
Yes, sir. That was awesome. I loved watching that. Click through. It's super simple and easy, and that sushi little picture is pretty awesome.
I know I'm getting hungry over here, but it's okay. Yeah. Whatever. I'll get sushi after. But let's get to our first question. This one is coming to us from Austin. Austin says, index funds seem to be very popular these days. Are there any disadvantages investors should be aware of? Good question, Austin. What do you think?
Hard for me to think about a disadvantage of an index fund, to be honest with you, because I think they're so diversified and they're low fee. So if you look at, there's a thing called an MER, management expense ratio. That's how much you pay every year for that fund to be managed. Index funds have really low costs. So the only disadvantage that I could see is just being spread out too wide across like a sector or an industry. If you want something a little bit more honed into like say tech or real estate, you might want to consider a different type of index ETF, but having like a broad one might be a little bit too broad market.
Yeah, that's a good point. I mean, like certainly management fees too are top of mind. One thing that I think some investors get into is you could say like that their eyes get bigger than their stomachs when it comes to like picking ETFs. Like they might pick different ETFs and they have a lot of the same exposure within them. Yet some have higher fee than others. So that's another thing to kind of watch out for. Make sure you're not biting off more than you can chew as far as fees are concerned, because you're not necessarily getting benefit for that. So just being judicious, being thoughtful with our spending in the same way we're thoughtful with our ETF selections too, I think is another thing for people to keep in mind as well. Let's get to our next question. This one is coming to us from Minel. I've been dollar cost averaging into ETFs for several years and feel ready for the next step. Any comments on moving into individual stocks? Nelson, what do you think about that?
I think my question is back to Manel here. Do you feel that you're not progressing in the way that you would want to progress? Because if dollar cost averaging is working for you, going into individual stocks only increases your risk tolerance or your risk profile. So you have to assess if your risk tolerance is ready for that. Because if we watch the market, some shares, depending on what industry and what sector they're in, they can swing 5, 10, even 20% per day. So if you're ready to kind of take on that risk, then you can look at getting out of the dollar cost averaging strategy and moving into a individual stock strategy. But I think for most people, dollar cost averaging over the long term gets you ahead.
Yeah, that's a good point about making sure that you're actually ready for this from a risk tolerance perspective. And Manel, one thing too that some investors do is they use what's called like a core and explore approach to investing. So they'll have maybe like their index funds as like the core of their portfolio. That's where most of their money's going. But then they dabble in individual stock picks or other things like that within the explore part of their portfolio. So something to consider too. You don't necessarily have to go whole hog into one or the other. Okay, let's call up our next question. This one coming to us from James. What should investors keep in mind when choosing investments within an FHSA?
James, that's a great question. A lot of people jump into investing and they think, oh man, I want to get like the best and the highest returns possible in the next couple of years. But with high rewards comes usually high risk. So if your plan with your FHSA is to purchase a home maybe in the next 1 to 3 years, you really want to think about your risk tolerance here within that FHSA. Because if you're picking individual stocks, like in that previous question, you might be exposing your capital to a lot of risk. So when you need to take that money out for that down payment, when you're ready to purchase your home, it might not be the same 25K that you put in. It might end up being 20K. Or 18K, depending on how the market's turned out. So if your timeline, say, is a little bit more short term, like 1 to 3 years, you might want to consider something a little bit lower risk, like either fixed income or an index ETF, something like that. But if you think like, you know what, Nelson, I'm going to buy a home in 5 years, 10 years maybe, perhaps I won't even buy one, and I just want to maybe ride out the market, then you might want to even consider individual stocks at that point.
Yeah, good perspective. The timeline is really important when it comes to using FHSA. We were talking a couple weeks back during our Home Run Week feature here at TD Direct Investing, talking with some guests, and one of the rules of thumb that came out was, when you're like 12 to 18 months away from, putting down your down payment, that's probably when you want to really dial back the risk, because you want to make sure, to your point, Nelson, that money's there. Like it doesn't go down from like 25 to 20K. You want to buy this home ultimately, right? So that's something to keep in mind as well. Okay, let's keep this train moving. Let's see what else we got on tap. This one's coming to us from Kevin. How should investors think about the role of cash in their portfolio, including how much of it to hold?
It's a good question, Kevin. My personal take, and it could be different for other people, cash in the portfolio, to me, like cash in a TFSA or cash in an RSP, FHSA, I don't like to do that. I like to keep my money invested. I want my money out in the market working for me every day. I work hard for my money, so I want my money working hard for me. But that's not to say that keeping cash in a portfolio is a bad thing. Like some people choose to have some money kept on the sidelines to be ready for, maybe a little dip in the market or a little correction that they might anticipate. But again, it goes to kind of what Rob was saying earlier. Have the bulk of your money invested, maybe a little bit on the sideline ready to go if that's your choice. But if you want my personal perspective, I just dollar cost average it in. Right when the money goes into the account, it gets invested right away.
Yeah, keeping the money working for you ASAP is generally like a pretty good strategy. Not to say that there isn't room for cash on the side. Some people really like that. Like you say, it really comes down to your preference. One thing too, I'll just kind of add in is make sure you have an emergency fund in cash or some low risk investments, right? Because Nelson, tell us, like, how could somebody get in trouble if they don't have an emergency fund?
Yeah, unexpected expenses come up all the time from the most random places that you wouldn't imagine. It's always good to have an emergency fund. I generally recommend like 3 to 6 months of your living expenses ready to go in cash. Those don't really need to be in any sort of registered account like a TFSA, RSP, FHSA. I would actually keep those in a cash savings account that's just on the sideline ready to go. I'm not even thinking about investing that money. If I see a promotion for, a 30-day GIC, like a guaranteed investment, like guaranteed income certificate, I might throw it in there. But again, I'm not investing all that money into something that's locked away for a long period of time.
Yeah, I think some people have the temptation to, particularly like when people get really excited about investing, like I got to put every single dollar like in the market, and that's not always the best strategy. You do want to, be ready for emergencies that can come up, of course. Let's get into our next question. This one coming to us from Michaela. What's the worst investment you ever made, and what did you learn from it? Ooh, getting personal here, Nelson.
Oh, Michaela, that's bringing me back to a tough point in my life. I would say the worst investment that I ever made was listening to somebody else tell me what to invest in. So I had a lot of friends who were investing a lot earlier than me, and they had done a little bit more research in the market, and they were telling me what to invest in. And similar to today, like you may not be talking to your friends about it, but you might be watching on social media and you might be seeing, oh, I should invest in this stock or this thing, right? But if you don't do your own research, and if that thing doesn't align with what your goals are and your risk tolerance and your values, it could end up pretty nasty. So I would say for me, that was the worst investment decision that I made, and I learned pretty quickly after that.
Yeah, our friends and family, however well-intentioned, often aren't the best investment advisors, let's say. And you're right, it depends on different things can work for different people or not. I'm sorry you had to go through that, but hey, you learned an important lesson, right? So that's really good. I'm curious, Nelson, you say do your own research. How do you like to do your own research when it comes to investments?
Yeah, I'll start with ETFs, index ETFs for starters, because a lot of people will, they'll see these ticker symbols. Like I think we brought up on the screen VFV, and people are like, what is VFV? Like, what does that mean? So for starters, the easiest and best thing you can do is actually just Google it. Google the ticker symbol, and then it'll pop up, what is VFV? How much is it trading at? But deeper than that, the next level, you can actually go onto like the TD website or even like Yahoo Finance, something like that, where it breaks down the holdings of these index ETFs, and you can actually see what you're buying. So we touched a little bit on one of the disadvantages of ETFs, index ETFs specifically, is that they're so broad and they cover so many different stocks and sectors that if you were to purchase like 2 or 3 different ones, you could overlap. So a good way to research and do your own research on this is to figure out what is that index ETF investing in. So for example, if it's investing in Canadian banks like RBC, TD, you got shares in there, do you really need a second investment that also holds the same shares in there? Because then you have that overlap. So I think doing your own research tells you not only what you're investing in, but it also gives you that knowledge and awareness of where you want to put your money.
Yeah, right on. Being intentional about the choices that you make. I think that's like the recurring theme that we've got throughout this episode, and I think it's a really good one. Nelson, that's all the time that we have. Really appreciate you fielding all those questions from our audience and sharing those saving and investing habits with us. It's great stuff. I hope we've inspired people to realize that getting to something like $1 million is possible, and 100K can be that trigger point for them to get to it and sort of be motivated to reach it, because it is really powerful stuff. Really appreciate you sharing your perspective as always.
Awesome. Thanks, Rob. No, thank you for having me here, and thanks to the team for all your great work.
Absolutely. We'll have you back soon. And for those in our audience, of course, thank you for tuning in as always. Make sure you check out next week's episode. We're going to hear one young investor's incredibly ambitious plan to reach early retirement even earlier than usual before the ripe old age of 30. That's right. She's got some fascinating tactics that she's used that every investor can put to good use, no matter whether they intend to retire early or not. It's just really just good stuff to hear. So you want to check this one out. It's a really interesting story. Thanks again for watching Inside Investing. From everyone on the crew, we appreciate you, and we'll see you next time.
Have more questions? Check out the links to the right and in the description below.